All right, welcome. Today is April 21st, and you're watching a pre-recording of the beginning of our section. Technology, huh? I'm so excited to be here as a part of the NCRC conference. BSF and NCRC have worked together on a few transformative projects where NCRC has helped us to incorporate racial equity into our standards for banks, one section of which is products and services. In our work together, we struggled on a few issues, and today we're here to talk about one of those issues we're still grappling with. But before we jump in, I'll tell you a little bit about our standards work. Our Equitable Bank Standards are a collaborative and shared resource that provide a measurable pathway for banks to achieve social and environmental impact. The research portion of our standards work is to collaborate with social impact bankers, finance experts, economic justice advocates, and academic researchers to understand how to create and measure standards around bank impact. The field building portion is to take our continuous improving standards and have them one day adopted industry-wide. Our standards are broken into 5 categories: governance, operational practices, corporate citizenship, lending and investments, and products and services. And today we're here to talk about products and services. Next slide. Today's question: how might the banking industry support historically marginalized communities? Next slide. Freedom is not enough. 400 years of systemic racial injustice have had real economic consequences that result in an uneven playing field today. People of color in the US have been systematically stripped of land, homes, wages, and humanity throughout the course of our history. Lies and stories are strategically told by people with power in order to gain more power, resulting in implicit bias and explicit bias that we all live with today. As a result of all this, people of color are still earning lower wages, getting charged higher prices, and being provided less information and assistance in choosing financial services. When our credit systems rely equally on collateral, capital, credit scores, lower debt, and years of experience, people of color are systematically placed as higher risk. These risks mean higher cost loans or denial, causing folks to turn to predatory lenders. Either way, the price is not fair. Equal treatment for people at unequal starting points. When our account minimums, service fees, and penalties are left to discretion, bias results in higher requirements and higher costs for people of color. Today is our opportunity to think creatively about how to truly address fairness in pricing. As most of you know, financial health is made up of a few key factors: income and costs, wealth and credit. Well, 400 years of racism has led to lower incomes and wealth for Black folks, which leads to a denial of affordable credit and somehow being charged more when you have less money to begin with. And the next slide is just another representation of the equity image we all know so well. I'll give you a moment to take a look at this. Next slide. This slide puts those disparities in the format lenders know so well, the credit memo. We have collateral, capital, character, capacity, and condition. Next slide. And finally, we have entrepreneurship as a wealth creation tool. Business owners create wealth for themselves, their families, and their communities. But Black households have been denied the building blocks for wealth that allow access to the business capital needed to build a thriving business. Solutions to these disparities have been individually focused in the form of financial education and credit repair. BSF believes the banking industry must also focus on system solutions that do more than ask folks to adjust to the way things are, but ask us to adjust how we set up our systems to truly support people of color by offering more than just what they could have gotten elsewhere. Determining what is fair pricing, not just better than predatory, is key to actually providing fair pricing to everyone, but particularly people of color who are more commonly paying more. So to help us with this conversation, we have Casey Johnson with RSF Finance, Pete Smith with Center for Responsible Lending, and Charles Elliott with Beneficial State Bank. So to start us off, our conversation off, I want to ask you all, if you were to create some standards for lending and deposit-taking institutions when setting fair pricing structures, what would they be? But before you answer the question, please introduce yourselves. And you all can take yourself off mute now.
You want to hop in, Quinn?
Casey, you can start us off.
Hot seat, perfect. So hi, my name is Casey Johnson. I'm with an organization called RSF Social Finance. So we're a nonprofit financial intermediary. We bring together a community of about 1,600 investors, donors, and about 100 borrowers. And together we're driving financing solutions for these values, impact-driven social enterprises across the US. And I sit on our relationship development team. So I'm both bringing in new borrowers to RSF, helping to support the financing structures like we're talking about today, and also supporting a portfolio of existing borrowers, helping them to just navigate the highs and lows of being impact-centered businesses. So Quinn, you asked a little bit about a standard for all of this. And I think the first step, just to reflect on what you shared with us today, is it's not a standard, but it's necessary for us to get there, is just for us as financial institutions to own our impact and to own our power. Black and brown communities have been systematically excluded from and exploited by our country's financial systems since the very beginning and all through to today. So just in order to move forward, first and foremost, I want to name that harm, and we have to commit the power that we have, which is immense, to wielding towards healing, or at the very least, towards building a just financial system. So specifically, thinking about fair pricing standards, I think a really simple model to help inform this conversation is don't take more than you give. So the purpose of finance at its very best is to just meet individual and societal goals, right? We're in the business of pairing together capital holders and capital takers, seekers, to create economic opportunity. And so unfortunately in practice, I think like the finance industry gets a little mired in more short-term profit maximizing goals. We have those high interest rates, those accruing fees, and commonly we're extracting more from our clients than the benefit that we're offering. So back to that motto, don't take more than you give. It just calls for a reframe. It requires us to give up that crutch of risk return assumptions and, instead think about our pricing with an expanded definition of risk, which is to include like the risk to our borrowers if our products fail them. And I would definitely encourage you to check out Seed Commons. They just have a really beautiful framework and principles for non-extractive finance, and they're walking the talk. And I think last note, just to be clear, like I'm not necessarily suggesting that banks can't profit off of communities of color, although I do think it could be argued easily. But there's a McKinsey and Company study to point to that calculated that closing the racial wealth gap would result in an additional 4 to 6% GDP. That's over $1 trillion by 2028. And so I'm suggesting that actually that banks should profit off of communities of color's success and not off of their failure in extraction.
Thank you, Casey. Go ahead. Go for it, Pete.
Hi, everyone. I'm Pete Smith from the Center for Responsible Lending. We're a research and policy organization affiliated with the Self-Help Credit Union and the Self-Help Federal Credit Union. We're based in Durham, North Carolina. We've got offices in Washington, D.C. and here in Oakland, California, where I live. I'm a senior researcher here at the center, and I've been here for 15 years and seen a lot of ebbs and flows of good and bad products through the marketplace. Thanks a lot to Quinn for having me, and to Beneficial and NCRC for supporting this event. Your comments at the beginning were really insightful, and they do a great job in grounding this whole conversation. As far as CRL's work goes, a lot of our work on pricing is from the angle of advocacy. We are affiliated with Self-Help Credit Union, and so we do have partnerships with them, and we get to sort of think through the way their bank practices work. But more broadly, we're thinking about the entire kind of ecosystem of pricing and products in the banking system. And we think, of course, that there's transparency, there's sustainability in pricing decisions. But we think about things in kind of a two-part way. It's not only about the pricing, it is about the products that are offered. Conversely, it's not only about the products, it's also about the pricing. I think if there are some products where, sort of regardless of the price, the structure of the product is such that it is likely to create debt traps for customers and consumers, and that's our primary concern as advocates, is preventing those kinds of traps and those sort of bad structures that are flawed from the outset. At the same time, of course, no product is invulnerable to pricing, to overpricing. So regardless of how responsible a product is, if it's priced unfairly, it will have a harmful effect on consumers. So yeah, I think that's the best way to describe the way we think about it.
Thank you. And I'll pass it to Charles.
Yeah, thanks, Quinn. So Charles Elliott, I am with Beneficial State Bank, not Beneficial State Foundation. We are a for-profit bank, and we are federally insured with the FDIC. We are obviously closely affiliated to Beneficial State Foundation, and I'm a part of our consumer lending portion of the bank. A larger portion of the bank is our commercial lending group that does a ton of great work as well. But the portion of our mission that I've internalized is really trying to continue to serve the underserved and provide access to credit. So a lot of that is what guides my work. And fairness is tough because, as Quinn outlined, technically risk-based pricing is fair. But when you outline everything that Quinn outlined, is like the ramifications over time that have negatively impacted groups. It's like we need to work to go beyond fair pricing and work towards equitable pricing. And it gets a little murky in terms of consumer finance, because technically if you have to be cautious about trying to do good and providing more than like equitable pricing to a group, and not in turn discriminating against another group in the process. So it becomes a little bit difficult, but it can be done. The framework exists within ECOA as of 1976 to work on like special purpose credit programs, or work with nonprofits to help assist, and whether that be through credit enhancements or other things to try and have additional impact. And there's actually work that we do with the Beneficial State Foundation for the Clean Vehicle Assistance Program to do something very similar to that, to provide lower interest rate loans for EV finance vehicles to borrowers as low as 500 FICO scores that may not be able to get interest rates as low through this program if it weren't for this partnership there. So I think for me, it really is just trying to get just beyond fair, because unfortunately we understand that something can be considered fair, or a lender could be considered doing good in the community, and that just means that they're not like charging usurious rates in the above 36%. And that's a really low bar to get over. And as Pete said, there are just so many predatory lending and fee structures, whether it's deposit side or lending side out there, that it's just being better than the alternatives isn't really enough at this point.
Cool. Thank you all for starting us off. And I also noticed that I failed to mention my full name and title. I'm Quintavious Williams. I'm with Beneficial State Foundation, and I'm the Associate Director over the Equitable Bank Standards Program that I mentioned earlier. Move right into our next question. I would love to hear a little bit more about how your institutions approach this question, if at all, particularly from Casey about your organization and from Charles's Pete as well afterwards.
Cool, yeah, I can dive in again first. And yeah, I think like Charles brought up, fair is a hard word to qualify, and I think it's also who gets to define what's fair. So for RSF, one of the ways that we've come about approaching this question is first to, put equitable pricing in the hands of our community, decision making in the hands of our community, as opposed to, the decision making power of the markets or even like the financing institution. And so, back in the day, like many banks, RSF based our pricing. When I say pricing, I mean the interest rate we pay or investment return rate we pay to our investors, as well as the interest rate that our borrowers pay. We used to base that on LIBOR, so the London Interbank Offering Rate. And then back in 2009, we actually decided to in-house this important work, and we developed our own benchmark, and it's called RSF Prime. So we've been doing this ever since. And instead of now having the market forces, and put quotes around it, dictate interest rates, we're actually facilitating a conversation with all three sets of stakeholders sitting at the table, visible to one another, engaging in direct and transparent conversation. So, our investors, again, they're our source of capital. They have their interest return on the table as part of the discussion. RSF is the financial intermediary. Our revenue share, which covers our operations, that's on the table. And then for the borrowers, the interest rate that they pay on their loan is on the table. And the question at hand in those conversations is, what are your needs as a borrower, and how would any change in the interest rate, whether up or down, how would that affect your ability to meet those needs? And the same question to investors, your interest return rate, how is that going to affect your ability to meet your needs? Same to RSF as an intermediary. And we host this conversation on a quarterly basis. So every quarter we're doing like a temperature check and getting a sense of our community's needs and adjusting RSF Prime according to those needs. And it's astounding, because like I'm sure we all feel how our culture is so caught up in dehumanizing the other. But when you sit down at a table with somebody, when you share a conversation about their needs and their work and their dreams, it's so hard to lean into that self-maximizing principle that we're taught. And I haven't been to a pricing gathering yet where a borrower doesn't stand up and say, actually, I've had a really good year and I can afford to pay a little bit more if it means that you as an investor can bring more of your capital to the table and we can support more borrowers in this community. And the same thing, investors say, actually, I've recognized that the investment return doesn't change my ability to meet my needs. So I can take less in exchange for you borrower having more flexibility around meeting your needs. And the benefit, it's beyond fair pricing. It's also creating relationships, not just financial transactions. And I think one of the coolest things I've noticed is like those relationships create so much more resiliency in our community than any kind of pricing standard would from the transaction side. So that's one thing we're really proud of at RSF.
Would either you like to answer? Go for it. Yeah.
Yeah, I can jump in. Cut Pete there on this one. Sorry. So I think a lot of it is just an intentional design for products and or services, and the pricing is obviously a massive aspect of that, and but also servicing. And I think just trying to find ways, and Pete mentioned this in his intro. It's not just like, it's making sure that our products are set up to where people aren't set up to fail, and we're not trying to entrap them into something that they're going to do, like unable to make payments on or handle that debt. So we, I think we just have to continue to try and experiment and be on the cutting edge as best we can, even as a community bank where we may not have the scale or the investment into some of our own infrastructure to do some of these things, but going outside the box, partnering with other like-minded groups. Like we ran almost a 2-year experiment with Common Sense Lab out of Duke, and we set up borrowers' loan repayments to mirror the payment frequency from their income source. And during that time, 100% of the borrowers that were part of the experiment group were able to pay current and maintain current. And out of the 1,000 people that were in our sample, 17 people defaulted, but they were all part of our control group. And just finding ways to set up not just our pricing, but also the servicing to align well. So it's setting up people to prosper through the loan that they have. And that's a big part of it for us too, is just understanding that it's not just how many people can we say that we've helped by extending credit, but what's the impact of that credit on their life going forward, and making sure that we're taking steps to measure that impact as well.
I love that Common Sense Lab at Duke. They do such great work there. I appreciate both of these answers, and appreciate Casey's mentioning explicitly the kind of dehumanizing effect of the way the market can work. And just glad that we're all here kind of pushing to get past that, get beyond that in various ways. So at CRL and at Self-Help Credit Union, we primarily operate from a place of mission orientation. The credit union has been around for 40 plus years, operating to serve communities of color, serve underserved communities, provide fair and equal access to financial services. CRL has been active for about 20 years, a little bit more than 20 years. And we are focused on protecting that wealth. So the self-help side is working on creating wealth, and we at CRL are focused on protecting that wealth. So we primarily operate from a place of mission orientation. Of course, we live in the market. We do operate as a salient and solvent financial institution, but we also inform one another. So both sides of the conversation kind of are active at all times. And so we at CRL are constantly sort of gut checking our advocacy and our positions on the financial experience and the lending experience that the self-help side has. And self-help side is constantly gut checking, is this practice fair? Is this practice going to have a kind of unintended negative consequence on our borrowers? Because that's not what, we use one another to really inform and give us credibility and push forward the good work that both sides can do. And so I just think that is a really excellent opportunity to improve both sides of our work. We are data driven, both at self-help and at CRL. We've started our kind of CRL work with a lot of very high intensity quantitative mortgage analysis. We've moved into a lot of different areas, and there are some areas where there's a lot more data available and some where there's a lot less data available. But we do what we can to make strong data-driven arguments. And then we fight with each other, and we have internal arguments about policy, getting everything right. There's a lot of really passionate people here, and a lot of people arguing in good faith for some different particulars on some of the policy standards. So there's no one size fits all for us, but we do operate from a place of mission and data both.
Cool. Thank you all. So I'll transition us a little bit. I know that when we were prepping, we talked about the two various perspectives that we have around consumer and small business. I know that Pete, you and Charles are both focused on consumer. CRL is consumer advocates. and you as a consumer banker, Charles. I would love to ask you both a question from your own perspective or organizational as well. Hear a little bit about some of those debates, Pete. But what are the most pressing issues facing communities and potential customers that the banking industry should prioritize solving? I'll start with you, Pete.
Yeah, so I think for us, there's just a huge problem of income insecurity, but maybe even beyond that, a problem of income insufficiency. These are things that we need the financial service to focus on, but we need more than just the financial services industry to focus on this. There are some issues that can't be fully addressed by financial services. Now, for the things that can be addressed by the financial services sector, we need to take a critical eye on the products and the structures of the products that we put out there in the market. There are too many traps in and out of banking. So for banks, for instance, some folks get drawn in with fee-based overdraft programs. This leads to a lot of accrual of greater debt trap cycles. Then people, in fact, are kicked out of the banking system because of these fee structures. There's a lot of kind of small dollar products that have structures that kind of can operate in the same way. So just simply kind of clearing up the minefield that awaits some folks on their kind of first entry to the traditional banking system would go a long way toward making things fairer and addressing some of that income insecurity, at least not sacrificing so much of the income that people do have. For specific issues, I think defending the CRA, making mortgage credit available, eliminating fee-based overdraft, or sort of taking a critical eye on the ways in which it is harmful to folks and dangerous and can lead to debt traps. We've seen in the past year the Paycheck Protection Program and some other small business relief programs that have started in good faith with the federal government. We've seen a kind of uneven rollout rather for those programs. And so we've seen throughout all of this, communities of color kind of bearing the weight and bearing the brunt of the abuse and not getting all the benefits to start with. So there's a lot of work for financial services to do. However, there's more work to be done beyond that. And, I think there are some financial institutions who in a rush to sort of make more credit available are overextending themselves perhaps and providing access that could be predatory. So we want to kind of find that balance and calibrate properly between providing a lot of access, providing a lot of credit availability, but not going too far, or making sure that we're being responsible, so to speak, with the products that we offer.
Yeah, and I think Pete brought up the PPP program, and obviously we are actively in a pandemic still, and we're 13 months in, almost to the day, I guess, in some, depending on where you start that count. But the other, on the consumer side, again, which is my focus, and a lot of what we do and what I do at BSB is auto lending, and we're in a point right now where, for the most part, people's credit scores have been preserved through, in some ways, the government stimulus did help. It was, I don't know if anyone would say it was enough, but what came out definitely helped. We saw that in our own delinquencies internally, where when stimulus came out, delinquencies went down. But beyond that, I think one of the negative aspects of it is that, depending on who you had your loan with as a borrower or as a consumer, there wasn't any mandate. It was, hey, lenders will let you set up how you want to do deferments for payments. At BSB, we allowed people to defer up to 6 loan payments on their vehicle. Other lenders didn't offer any relief. Other lenders offered 90-day relief, things like that. We're still actively allowing people to defer payments, and a lot of other lenders stopped at the turn of the new year. But the problem is, like, this pandemic is still not over. There's still really high unemployment, so we're just trying to manage through that whole thing. But it's just a really opaque process, especially, and like it's very easy on like the auto lending side to blame a car dealer. They're an easy target in a lot of ways. They deserve a lot of the negative aspects of it, but to be fair, the financial institutions that are financing are completely implicit in all of this. A lot of the negative practices are reinforced by the lenders because it's a means for them to compete with one another to win that business. And as long as lenders are complicit in these practices, the auto dealers are financially motivated. They're not going to change. I think additional regulations help, certainly. But so just trying to, at BSB, we've acknowledged what we can do on the purchase side, and a lot of that is getting with a borrower before they go to a dealership. So it's not dealer arranged financing, but it's making them aware of what pricing they can demand and what they can finance themselves before they go. But so much of it already is a dealer arranged financing. So we tried to go on to the back end of that, where we're doing working with partnerships to do refinances, where if someone's already caught in a bad loan where they've got a 24, 25, 26% interest rate, we can refinance them out of that debt. And over the last 4 years of doing this, we've been saving borrowers an average of 7% APR on their new loan with us. So like we're talking, like in some cases, it's cutting their interest rate more than in half. But I think beyond just that, I think it's like working on how we can target partnerships within our communities where there's already a need, where they're coming to us. And we recently had something that we just launched this year, I'm really excited about, is we had a nonprofit out of the Southern California come out and reach out to us wanting to launch a program where they were able to work with a utility company here in California to install EV charging stations at their affordable housing communities. And then they wanted to assist their residents in obtaining financing for EVs at fair rates. So we were able to work out a partnership with them, as, again, leveraging a credit enhancement to offer sub 6% rates to borrowers down to 500 FICO scores. So that is, and they came to us with a need in their community, and then our just approach to try and meet that need.
Cool. Thank you all. And for you, Casey, from RSF's finances perspective, in your personal perspective, what are the biggest gaps right now that banks should fill for entrepreneurs of color?
Yeah, the one that popped to mind for me as I was thinking about this question, it ties back, Quinn, to the introduction you shared with us and the effects of systemic racism, one of which is that Black families now have on average about a tenth of the wealth of our white families in this country. And so among a whole slew of outcomes, one of those is that Black entrepreneurs don't have access, most likely, to the same friends and family capital, right? To get their businesses off the ground, and then to get them ready to join a debt partner like RSF or, another conventional financing partner. And so equitable lending practices, we have to account for that. We have to realize that one size doesn't fit all, and that communities of color, entrepreneurs of color in particular, are going to benefit from a blended capital solution, meeting them where they are. So at RSF, one of the ways that we practice that and live into that reality is what we call an integrated capital approach. So as opposed to that one size fits all model, we're using a whole spectrum of financial products and non-financial, so that we can center a borrower's needs in both the investment structure and the relationship. So, on the financial end, we have a senior secured debt portfolio, not very generous in terms of the credit policy and what we're able to do out of that risk profile. But what we do instead, or in addition, is we raise philanthropic funds. And so these are what let us fill the gap between an entrepreneur's needs and that more traditional credit policy that we have with the big portfolio. So these philanthropic dollars, they can do anything. It can be sub debt. It can be, guarantee to bridge a lack of collateral. Maybe it's a grant for technical assistance, or it's some equity-like product. This philanthropic capital doesn't care what somebody's credit score is. doesn't care where they're coming from. It's all about making up the gap so that we can put those entrepreneurs on the same footing and level the playing field. And again, like we've talked about this in the last couple of things in Clint did, it's about thinking about risk differently too. So a lot of us as bankers, our risk meters go off when we're talking about under collateralized loans, uncollateralized, God forbid, or earlier stage enterprises. And so in our heads, we're ratcheting up the interest rate and the pricing on those loans. And doing so perpetuates that systemic institutional racism where higher rates are charged to borrowers of color. So at RSF, because it's philanthropic, we've built our capital stack intentionally to allow to ourselves to be able to charge low interest rates on those products and services. We're also not even all that concerned about the risk of losing principal on that philanthropic capital. We're actually more concerned about the risk of not supporting that amazing entrepreneur who has an awesome idea and needs the support to get off the ground and to build wealth for their community. So anything, just like to expand this a little bit, not everybody's going to have that perfect capitalization structure. We're still learning about what perfect actually means, but outside of the capitalization structure of any given institution, I think one of the coolest things that you can do is to collaborate as a financial institution and to recognize that there are already institutions who are grounded in like a place and a community and a culture and to support their work. So I know RSF has a couple of partners I'll just call out because they're really amazing. Native American Bank, built off an understanding that tribes need banking services that understand their needs. And so for Native American Bank, they understand the context and the culture. So to them, lending into Indian country doesn't look like risk. It looks like opportunity to lift up their community. And another shout out is Runway. If y'all haven't heard of Jessica Norwood, but she asked the question, what would it look like if the financial system loved Black people? What would it look like if the financial system loved Black people? And so Runway provides entrepreneurs with early stage, it's We Believe in You funding, and it's holistic business support, and it helps to bridge the racial wealth gap so that African Americans in their local communities can build wealth. And it's incredible work. And so these folks are the ones who are really leading the way on fair pricing and filling financing gaps because they know their communities best and what they need. So I think the other thing for all of us things to keep in mind is you don't have to do it all, but reach out and partner with the folks who are leading the way on this work too.
Thank you. What a statement. What would it be like if the financial industry loved Black people? Okay, so for our last question, which is a great segue into it. So move my screen over. So post George Floyd's murder, we have seen corporations and institutions pledging to take significant actions to address racial inequities and injustices in society. From corporations like Netflix and PayPal putting highly targeted investments into Black-owned financial institutions to increase donations to HBCUs, and I went to Morehouse College. We also increased urgency around Black representation in C-suites. With these and the guilty verdict in the murder of George Floyd, to me, it feels like we're reaching a tipping point in corporations supporting Black lives and people of color. I just want to ask you all, how do you see this moment in time? And do you have a sense that we will see sustained action or progress, especially from actors in the financial services sector, in about 2 minutes each? I know that's a lot to cover in that time, but that'll close us out for the pre-recorded session. And start, Pete, go for it.
Take a try. This is a huge question, and I guess I'm a person of hope, so I'll just say I hope so. Beyond that, I hope for continued public awareness and public attention paid to all of these issues. Not only to the banking specifics, but just the pitfalls of the current system that we operate in. I think that it would be a much better world with a more diverse representative set of people in charge of our current system. But I still think of that only as a way station along the way, as a stop along the way. Because I think there's a lot of reform work to be done, and not only who represents the banking system, the financial services system, but how it works and how it operates in terms of the lenders, the borrowers, the consumers, the whole set of people. I think we have the power to design a fairer system for everyone, and it has to start. And I'm glad to see the early steps of it starting with representation, but I think it's got to go beyond that. We need true equity. We've seen deficits and disparities across hundreds of years, and even in the kind of 100 years of what we think of as banking in America right now, we've seen the impact of poor and racist decision making, skillless and intentionally poor decision making on communities of color. And in order to reconcile those disparities, we can't just aim for fairness. And I think Casey and Charles were both alluding to this or speaking to it directly. We can't just aim for fairness. We need, affirmative service towards communities of color. And if we're going to do anything to correct any of these inequities, maybe we can't correct these inequities, maybe in the past, but we can work affirmatively in the future to make sure that people get not only what they need, but what allows them to thrive. I think there's a long way ahead of us, a lot of work ahead of us. We're only part of it. All of us here are only each one part of it. But I do have hope for the future, and I hope that we can continue to step forward on this path.
Oh, yeah, sure. I can. Yeah, sure. So, I appreciate Pete and the hopefulness aspect. For me, it's tough. I was thinking about this, and I'm sometimes a pessimist in nature, and I think in some ways it's because it's easier for organizations to just chalk up a social media win and manage a perception, but then not take ownership of needing to address the actual change or do something. And I think that's what it really boils down to, is that accountability, that we hold ourselves accountable to actually work towards change and hold the other organizations and our own organizations accountable as well, to not just try and get something out, a tweet out there and get a bunch of likes and then move on and never actually change anything. And within financial services, the reality is that there are CDFI banks that are considered good and get good CRA ratings. And I worked at one that ran a model that could project someone's going to default within 6 months and still make that loan. And those are the actors that frighten me. And I think just hearing, understanding that there are good actors out there, and maybe trying to take a little bit of the hopefulness aspect of Pete, is that acknowledging that there are good actors in finance, and that hoping that they're working to tread an alternative path. It's more regenerative. And I think it just comes down to accountability for ourselves and for others, and making sure that we actually strive to do real change.
Yeah, I've been pinballing between these two also, because on the one hand, Pete talking about representation, we're 3 white people from representing the banking industry, and that's unfortunate. Allyship is important, but obviously it's not everything. And then it's so much easier to be pessimistic, because then it allows us to not have to change. But riding the wave of yesterday's decision in Minnesota, and all of the hope that has been built over the last year, I do feel a little bit optimistic. So I'm going to at least share that side. Because I know, just reflecting for RSF, we've had to reckon with our own role in perpetuating systemic racism. And, we're a nonprofit, we mean well. It's not necessarily the headlines of racism in banking. It's not redlining, whether blatant or subversive or extractive pricing for communities of color, but there's so many quieter forms of racism in financial services. And so, it's having a predominantly white team. It's especially at leadership levels and loan officers. It's loan policies that at least implicitly mean that most founders of color are rolled out. And, it's loan docs that you can't read without having an attorney's education, whatever that's called, legal background. And And there's just like, and it's a comfort with the status quo. And I also, though, have seen over the past like 4-ish years with RSF, like these realities have moved from the periphery and something that we could avoid to they're the center of our decision making on a daily basis now. And that's because staff have pushed, that's because our community of investors and borrowers have brought this to us. They've pushed us to wake up, to do more, and to like actually live into our values. So now, you know, it's not perfect, but we've made a lot of progress. We're tracking demographic information of our borrowers and their boards and their beneficiaries. We've diversified our board and staff. We're joining a community of banking peers to move our credit policies forward. I think Beneficial, for instance, has a underwriting racial justice program that we're participating in. That's awesome. And, you know, like RSF has a smaller community, so I think we have a tighter feedback loop. But I have no doubt that banks across the country are feeling this like tidal wave, pushing them to wake up and to actually show up. And I like, most importantly, I hope it's like truly becoming a question of relevance, because there are so many financial institutions like community banks, the folks that I mentioned, like Seed Commons and Native American Bank and Runway, who are doing this work, who are connected to their communities, who are like growing, and they're ready to take up the space that they deserve. And so I'm hopeful that one way or another, you know, either the old force, or especially if we can welcome the new force into banking, I think we will see sustained action.
Thank you for ending us there. And we will shift over into our live portion for the last 15 minutes of it. Cool. All right, pulling everybody up. Cool. All right, well, based on our questions, I have a few pulled up. So first off, Pete, can you tell us your thoughts on product, services, fees that should be started or worked on or eliminated?
Sure. Thanks again, Quinn. I think 3 things jump out at me for things that we could immediately work on within financial services. The first is pretty low-hanging fruit. It's bank overdraft programs, specifically fee-based overdraft programs. These are high-cost fees that, with only a small overdraft, perhaps even $5 or $10 or even $20, people are getting $35 fees that are paid back in an average of 3 days. So this is an extremely high extension of credit. And it's not really commensurate with the risk that the bank is taking on, because the bank can immediately take back the assets as soon as they get back into your account. There are far better alternatives to this too, where there's a small line of credit. All it takes is $50 or $100 of a line of credit to make sure that those purchases are covered. It covers all the risk for the institution, and it makes for a much lower cost product for customers. So that's one thing. We think that drains probably about $15 billion a year from Americans. That is a whole lot of money being taken from people that don't have those means to begin with. Second, I think there's an opportunity to do some lending, and then an opportunity to be careful about what kind of lending we do on the small dollar side. Whether it's an installment loan or a balloon loan, we think loans should be affordable. We think 36% is a very, very easy bar to meet for loan products. Certainly, we should have terms that allow loans to be paid back over time and not all due in a lump sum. At that point, it looks more like a payday loan than it does another service that we'd like to think the mainstream banks and credit unions would offer. There's a lot of detail, there's a lot of state-to-state variation, but we think that there's a set of good principles on which banks can offer responsible loans, even at a small size. Finally, affordable mortgage credit is not going to become less relevant anytime soon. We need to be partnering with FHA. We need to be partnering with other government programs to provide mortgage credit to people of color, to African American communities, to Latino communities, to Asian communities. And we just need to be out there making sure that people have access in a world where not everybody has access to familial wealth or wealth passed down through generations. Owning a home is still a very good way to build up wealth and to build your circumstances that you can potentially pass on to your next generation. So I think those are sort of 3 first steps.
Thank you, Pete. So the next question I have is, how can funders and entrepreneurs share risk instead of entrepreneurs shouldering all the risk? And that's for Casey and Charles. Can you tell us a little bit about how your organizations are approaching that? We'll start with Casey.
Yeah, sure. And I mentioned this a little bit in our recorded session. For RSF, the way that we think about sharing risk is diversifying our capital stack. I think for all of us banks, we need to assess, your business model and how that's tied back to fairness. Who are you making money off of, and what are the social impacts of those revenue streams? If you're being honest with yourself, you can probably find opportunities for racial economic justice within your business model, and then tying back to your capital structure. So, what are the sources of capital and what flexibility do you have? If you don't have any flexibility with those sources of capital, how can you supplement? Or how can you partner with other entities that are better positioned to fill in the gaps for you? I am really excited about the ways that philanthropy is stepping up right now. So a lot of foundations that are, activating their endowments to be able to put MRIs, mission-related investments, program-related investments, being able to invest flexible capital, patient capital, also grants, technical assistance grants, even for for-profit companies. That's going to hugely open up the opportunity then for banks to come in and do what they do best in a fair and equitable way, but to fill the capital stack of the entrepreneurs that they're more comfortable with. So I really do think it's about partnership. It's about being, expanding your toolkit as a bank.
Yeah, and then just to kind of follow up on that in regards, there was a very specific question about 0% interest loans for businesses that meet either economic development or community development goals. And at Beneficial State Bank, we do not have that type of product. We do something that closest, like the most similar thing that I think that would be somewhat relevant is that we do community sponsorship dollars, and we have a community sponsorship committee within the organization, and we receive requests from nonprofits within our footprint near our retail locations, and we review those and try to get the dollars back into the communities to support these nonprofits. So that's like the closest thing that we have to that, but not 0% loans at this time.
Cool. And the final question that I have is, can you all share your thoughts on increasing banking access? We saw in the chat, someone asked about public banking and postal banking, and I'll start with Pete, of course.
Sure. I love the idea of postal banking. I am a record collector and I use the post office for almost everything. I love the post office. I would love to see them in charge of more things. But, I think in a serious way that they have an infrastructure and they have an ability to serve Americans across geography. And it's just something that we took for granted, or didn't take for granted, but we took as something that we assumed that everyone should have access to. And I think we may think of banking that way, but it's not exactly that way. We've seen, 5.4 million unbanked, I think, is the newest number from the FDIC in last year's report. And, we at CRL try to think about what's pushing those people away. And I've done a lot of work on overdraft over the years, and we've seen a lot of people get pushed out of the banking system due to overdraft and some unclear and confusing and very high fees. So I'd say, yeah, expanding banking access is terrific. Also, not losing banking access is the other side of that for me.
Casey or Charles, you have also this last question for me, follow up or final thoughts?
Just the only thing to add to Pete's is the aligned incentives. Postal services, they're based in our community. They're members of our community. And as a public service, the incentive would be to serve people and not serving profit maximization. So I think that incentive alignment is really important too.
Yeah, and I think again, also a fan of it in theory, in the standpoint of I think it would help kind of root out and create a really good competition for some of the like least savory financial practices that exist in a lot of communities as well. So I think that in itself is one of the reasons why I'm a supporter of it.
Yes, and Beneficial State Foundation is in strong support and advocate of public banking, particularly state public banking, local public banking. And we'll go to our closing slides. Information as well. I saw a couple of questions, particularly that would be relevant for Pete, and to reach out to other folks as well. Yes, and Charles also said in our chat that he would be happy to share his contact with a few other people that have questions related to behavioral science, and that will be shared as well. And I just want to say thank you all to the people that are coming, and enjoy your evenings and afternoons, and the last slide as well. Yes, and for folks that want to know a little bit more about Beneficial State and the bank standards, the Equitable bank standards work, you can go to our link. This is a new few web pages that was launched actually today for this particularly, that you all can go to, and Jamie shared the link earlier in the chat as well. Put the chat. And yeah, that is the end for us. Thank you all for tuning in.